So our panelists today are Alex Moore from Carrington Coleman and Chris Davis from Gray Reed. Got that right? Yes.
All right.
So if you guys can take maybe like a minute to talk about your backgrounds, just introduce yourselves and like what your experience in law has been, and then we will start the panel.
You bet. Experience in law, quite traumatic. Now, I run the crypto practice group at my firm, Carrington Coleman. My background is in securities, compliance enforcement, and litigation, both with the government but also private actors. And I've been a crypto hobbyist since 2013. Crazy story, my brother went to college with Ross Ulbricht, and that got me interested. After that was Mt. Gox. I started mining Bitcoin. I'm a very experiential learner, and I've been learning in the area, and then come 2018, when it was making headlines, I went to my firm and said, hey, look, I've been working on this area. It's adjacent to what I already do. I want to launch this practice group, and the firm had my back. And from then on, I've built a group of about a dozen lawyers that practice in different areas of crypto. A lot of what our work, bread and butter, is in the securities space, which is what we're going to hear a lot about today. We work with companies at every phase, from pre-launch, where they're trying to figure out how do we do this and color within the lines, to we launched but we're a little worried, to we just got a letter and we're about to get sued, what do we do now? And that's what I do in a nutshell.
Thank you.
Great. It's great to be here with Alex, who I've worked with before and is a great lawyer. I'm Chris Davis with Gray Reed. Similar to Alex, I co-chair our digital assets and blockchain practice with Joshua Smeltzer, who's kind of the tax expert, tax guy, former DOJ, and I'm an SEC guy in my past life, so to speak. I don't know if you ever really leave. It's kind of like the mob. You never really get out, but
He's got the tattoo.
yeah, I do.
Is it Gensler's face?
It's actually a brand, first of all. Yeah, if it was, I'll just leave that be. But the Gensler comment. But I did spend 10 years at the SEC before coming over here. In addition to the kind of crypto-related stuff, I have a more general securities compliance and investigations practice, which is when you get the dirty letter that Alex mentioned. But we try to keep that from happening. So that's kind of. And I'm a CPA too, so I have a natural proclivity for like things that are financial in nature, so it was just kind of naturally drawn to crypto for that reason.
Remind me, were you at the Fort Worth office?
I was in Fort Worth, yeah. Actually, so, what the SEC used to do, not to immediately just come out firing, but the SEC used to prosecute crypto fraud like we prosecuted all manner of fraud. I mean, it's Fort Worth. We had all kinds of oil and gas fraud, things that are kind of sexy draw fraudsters, right? And so I did our first crypto receivership, which was a company called Arise Bank, which was just
I touched Arise. That was a
yeah,
big deal.
It's just a fraud, right? I mean, it's a guy he said he had ATMs and banking licenses and things of that nature. None of it was true. I mean, he was just raising money and going to the outlet mall in Terrell, which is where we found like bags full of Under Armour. I mean,
At least he had good taste.
But as we'll discuss today, I mean, it's morphed into something totally different, to where they've kind of tried to stamp out an entire industry. As opposed to like exchanges that are trying to make this work and to color between the lines. So anyway, I mean, that's my background. It morphed from just go get the fraudsters to now how do we operate in today's environment, where they've kind of expanded far beyond, I think, what their mandate ought to be.
Major questions, let's go.
Yeah, there we go.
Okay, so we have kind of an agenda of topics that we're going to cover, and then if we can just save all of the questions for the end, we're going to have a Q&A. We're going to try to stay on point. The goal today is to cover kind of what's been happening with the SEC actions against the companies. We're going to cover a couple of the big cases that are a little bit different from each other and explain how SEC has been kind of attacking on multiple fronts. And then, talk about, I think these guys have amazing ideas about what's going to be happening and how will crypto maybe get regulated from different spheres, that are out there encroaching on crypto. And then we'll open it for Q&A.
And don't worry on the Q&A. For better or worse, both Chris and I have agreed to hang around here indefinitely. So if you don't get your question answered, we're we'll be here for you.
We will have to end this by 9. If anybody wants to, there is the Continental Club, which is right there on Congress, I believe. It's like super walking distance. They're open, no cover until 9 o'clock, okay? So I suggest everybody go there. They're also gonna have a show, so it's a good place to go to, okay?
By the way, can y'all hear us in the back? Okay, then.
I was gonna say, I feel like
I don't-
we're
I don't think
litigators.
I don't
we
think
project.
we'll use these as long as you can.
Here, Alex.
Oh, okay.
If you don't wanna, yeah.
I mean, so, yeah, unless you need it for a video feed or anything. I guess that's what the
Do you-
lapel
do you
mics
need
are
it for that?
for. He's got the lapel mics.
Perfect.
Great, so
We got our cocktail party conversations too.
let's start with that SEC mindset. If you guys can talk about, what is the SEC really looking for? How have they been approaching this? Why are they sending out these letters? Like, what's their premise? How do no action letters kind of play into this? And anything else relevant?
So, securities law. I think, honestly, everyone in this room at this point has been so exposed to the basics of securities law that even if you're not a lawyer in the space, you've heard the Howey test, you've heard about the 33 Act, these things. And, the SEC's overall charge, which ultimately Chris can speak to better than me, but I'll at least tee him up on the no action letter, which is a little more fun, is to oversee capital markets and investor protection when you're dealing with securities, which by statute and on purpose is a very broad definition that encompasses a wide range of things and is intended to be flexible to cover anything that could conceivably resemble ultimately an investment. And with that comes certain obligations when you sell securities, particularly to the general public, to anyone who's willing to buy in the open market. And traditionally, if you want to do that, you have to register and sell registered securities or be subject to some exception from registration. And so when we're looking at what the SEC is doing at the most macro level to engage with cryptocurrency, they're asking the question, do we think these digital assets are securities? And if so, are they complying with the securities laws? And that's about as good of a segue as I can give for Chris to talk about what no action letters are and why they matter.
Yeah, and the only thing I'd add is there's kind of, if you are a security, and that's kind of the factors that they're looking at here in the no action letter process. There's 2 buckets of regulation though, just to kind of piggyback on what Alex was saying. The first bucket is kind of around registration, which is actually a pretty onerous process. You've got to submit a bunch of forms to the SEC. You've got to have audited financials and do and then do periodic reporting after all these things that are very expensive and cumbersome to do.
But Gensler said it's easy, just come in and register.
Yeah, right. Yeah, if you've got a few $100,000 sitting around at a minimum.
And even then.
And then there's anti-fraud, which is simple. I mean, anti-fraud, even if you don't register, you still can't go lie to people, okay? But what the no action letter process allows you to attempt to do is get some certainty up front in terms of, are you going to fall within this regulatory framework? And what you see with the great chart that Olga has put together.
Kramer 11 has put it together. I forgot to
Good point.
write it on there. It's another
Good
law
point.
firm, and I stole it.
Yeah.
If you're listening, she just gave you credit,
Yes.
so no trademark
Legally,
infringement.
I'm okay.
Yeah. But what they're looking at here is essentially this set of factors that they've looked at to say, do you fall outside of the traditional securities regime? Because what a security is typically, what a security is an investment. And it's an investment. Think about your traditional security, stepping back from crypto, and say, if I'm going to invest in Microsoft, what happens? Well, I give Microsoft my money, and they pool it with a bunch of other people's money, and then they develop products that they then sell to people to make more money, and then we share in those profits, right? Well, crypto's different because you've got tokens that do different things. You've got tokens that are structured very much like that are traditional investments, right? And we've certainly seen some. That was the whole pitch, just to use Arise Bank again as an example. That was the whole pitch there was, I've gone and gotten these banking licenses, and this is going to be a super fast growing market area. Give me your money, you can capitalize on my efforts, and then the price of these coins is going to go through the roof and you're going to profit from that. Well, that sounds just like Microsoft, right? But there are all kinds of other tokens out there that are more like utility tokens. So that's what this is looking at. I mean, these are things that would distinguish those tokens from that, right? If you look at these things, they're not using funds from token sales to develop the platform. They're used for other functions, not just to return your investment. And I'm not going to read the whole chart to you.
No, I'll do that.
Yeah. But essentially what they'll do is you say, this is what we do. They'll look at it and they'll write you a letter back and say, yeah, based on what you're telling us, and they have to assume everything you're telling them is true. If it turns out it's not true, then guess what? They're going to come get you. But they say, we don't think you would kind of fall under our regulatory umbrella. So this is like outside the litigation process, part of the administrative process.
Are no action letters binding law?
Well, that's an interesting, so we don't have a case on that, but this actually came up in the commodities context within the last few weeks. And I don't have the case name in front of me. But there was a commodities CFTC no action letter that had been issued like 20 years ago that people have been relying on for years and years. And by the way, I work with our transactional practice a lot on the.
You're talking about the event futures deal.
That was probably it. Yeah.
This is how I made money on the 2016 election. What is that?
That's it. It was the betting markets. Yes, the betting markets. So
run out of New Zealand.
The political betting markets. There was an CFTC no action letter that had said years ago, like 20 years, right?
Yeah, it's been a while.
That this was not a commodities, therefore not regulated by the Commodities Exchange Commission. You weren't an unregistered exchange if you were setting up these betting futures markets. Anyway.
They're awesome, by the way.
And,
not investment advice.
And it was, not to totally get us off track, but it was Fifth Circuit, right? Like people had looked at this and relied on it for years. They'd set up a whole business around it. And then they came in 20 years later and tried to sue them. And so now there's a whole lawsuit about whether the CFTC can essentially be held liable for their inaction, not to mock the terminology here around that. So the point is, I gave a real complicated answer to your question. They're not supposed to be binding beyond this very limited case, but there have been some recent arguments that they are. And I expect that you'll see that maybe develop. But the general answer is these things don't really provide you much help. But as a practical matter, I'm sure your transactional folks, just like ours do, if you've got kind of a novel situation, they can go look at these no action letters and say, well, in this other case, they said a product that looks just like yours, they would not take action on it. So they use them as guidance, but there's all kinds of caveats when they give you these things. So it's a kind of buyer beware type of situation.
Yeah, I mean, we use these all the time. You know, we'll talk about the Ripple case and Terraform and the precedent, and people want to talk about, well, what's the law? No action letters give you an additional data point. That is a regulator telling you, in that specific case, on those specific facts, we are recommending that no action be taken against you for violations of whatever that legal regime is. And so if you're asking yourself, how can I do a crypto offering that I don't think is going to get me into trouble? You can look at these no action letters and say, well, if I try and do something similar to what, for example, Pocketful of Quarters did, I might mitigate my risk. Not for sure, it's not binding on different facts and circumstances, but it's interesting. It is some authority for that proposition. And I'd briefly echo something Chris said in particular, an analogy I often use when talking about crypto. When you're distinguishing between digital assets that are investments vulnerable to attack and digital assets that are what we in the industry like to call utility tokens. A common example that I think a lot of people know outside of crypto is Audible credits. Anyone here use Audible? Yeah, you ever done that? Yeah, so you go and you pay an annual fee, they give you a certain number of tokens, they're non-transferable, you can gift them, but you can't just freely trade them. There's no secondary market for Audible tokens. When you buy them and when you spend them, you're not investing in Amazon, right? They get your money, presumably they use them for operating expenses, an issue I want to come back to later, because one thing that drives me crazy in these crypto decisions is this idea that just because a crypto company might be using token sale proceeds for operating expenses, that somehow must mean it's a security. It drives me crazy. But so that's happening, and nobody would argue that those Audible credits are securities, are shares of Amazon or shares of Audible. They're just digital assets that you can use and redeem for online books, which don't necessarily have the same market value. In fact, you get a discount when you use the Audible tokens as opposed to buying in cash. It's a good example of a digital asset that nobody bats an eye about. Meanwhile, crypto is under siege.
Right.
And so you think that that component is basically missing in crypto right now, right? Where with other assets, just because you're selling something, just even digital or non-digital, you're selling something, it doesn't, and you're getting money, right? You're a company, you're getting money from consumers. Doesn't matter what you're using that money for. Obviously, you're using it for operations, like obvious, because that's why you're selling stuff. You have to pay for manufacturing, right, for salaries. But in crypto, they don't seem to be making a distinction between selling products or services and raising money.
I think that's a fantastic question. And so I think there's a lot of stink on the industry from the great ICO boom of 2018, where there were a lot of just boom fundraisers, where it's just naked fundraising. And the real distinction here, and I would hope Chris would agree with me, is token sales where you don't have anything. He gave the Arise Bank example. There is no product, there is no platform, there is no online Audible marketplace with books. I am literally just selling tokens to raise money to then go and build something. That is going to put you at significant risk for being considered a security. Contrast that with, I've already built my platform. I already have use cases. Maybe I raised private money via a private offering, which is exempt from registration, to build my platform. And now I'm selling tokens that you can then use to interact with the platform. And yes, I'm making money on those sales. And yes, I'm using those proceeds to reinvest in my operating expenses. I, in my professional opinion, do not think that should be considered a security. And the case that really killed me on this, to deviate a little bit, was the Top Shots case, where there was a class action lawsuit filed against Dapper Labs for selling and working on Top Shots. And what that court found in denying the motion to dismiss was, well, the plaintiffs have alleged that Dapper Labs, they would use the money from the sale of these NFTs to maintain the Flow blockchain. Well, of course they were. Why is this so scandalous? That's what businesses do. When Topps, the company, sells baseball cards, what are they supposed to do with that money? Like scroll it away into a trust fund, because otherwise if they use it for OpEx, it might be a security? It's absurd, and it's one of my trigger issues in this area, obviously.
Well, he stole my thunder, because I was just about to say the same thing, because that is where it gets conflated, and where I think, like Gensler, among others, has just been super freaking sloppy about it. And the Ripple case makes a good distinction. And there is case law on this too, by the way. They're not pulling this out of thin air. Just because you expect to make money on something, or just because you're speculating in something, collectibles, NFT, same example. People speculate in those things all the time. That doesn't make it a security, right? Cabbage Patch Dolls weren't securities. Pet Rocks weren't securities.
Wasn't there that one case where Beanie Babies were in New York?
Maybe.
What do we do about that?
Yeah.
So, go ahead.
No, this is a sidebar.
No, but I mean, it's just been real sloppy, and you saw it in some of the I don't want to jump too far ahead, so I'll just leave it at that, because we're going to get into some of this stuff.
So since you mentioned cases, so let's move on and talk about the big cases. So we'd like to cover today Ripple, Terraform, Coinbase, and Grayscale, because they each have something a little bit different going on within the cases and actions taken. You
want to kick us off on Ripple?
Sure, I'll kick us off on Ripple, and it's kind of tethered to Terraform. Tethered, not the
Yeah, I was going to say, we're not talking about the tether collapse, question mark?
But so the reason Ripple was a big deal for at least a week until Terraform came out, which I'll let Alex explain, was it was the first big case in which a federal court had actually found something not to be a security. Because the SEC had a big string of wins. Now look, a big part of the reason they had a big string of wins is because as things always work in these developing industries, they did the easy cases first. Again, Arise Bank was an easy case. I mean, I did it. That's great, but it was an easy case. I mean, it was obviously a security. And most of the early cases were obviously securities. And they had that whole fraud overlay to them, which isn't present in Ripple, by the way. It's a pure kind of registration type of case. But in Ripple, what Judge Torres did there, and Alex alluded to the Howey test, but let me revisit that, there's a three-pronged test, the three legs of the stool in SEC world for investment contract, which is the catch-all categorization for any security, is an investment of money, one, and money can take a lot of forms. But an investment of money in a common enterprise, which means essentially that pooling aspect that I talked about, where there's an expectation of profits based upon the efforts of others. And it says based solely upon the efforts of others, but it's not really solely in like any sort of normal English parlance, because lawyers said it and, you know.
Ask him afterward about strict vertical commonality.
Yeah, no, let's not. I'll definitely need some drinks. But the judge in that case did a very detailed analysis. And Ripple,
I counted as 4 for what it's worth. Investment of money in a common enterprise with an expectation of profits from the efforts of others.
Yeah. But frequently those last two get conflated into the third prong, which is how she analyzed it and how the judge in Terraform analyzed it too. But she looked at the different ways that these coins got into the marketplace. Okay, and there was 3 different ways. One was through sales to institutional investors, so hedge funds and the like. The second was through what they call programmatic sales, which were through exchanges, but they were blind bid and ask sales. So somebody says, I want to buy Ripple, XRP. Somebody in the internet says, I want to sell it. The exchange matches is like you got no idea who you're selling it to or buying it from. And then the third bucket was, what did she call the third bucket? It was not institutional, programmatic.
I mean, I think about it as like
it's employee. It's like employee stock
employees
options,
and
okay?
vendors.
Yeah, but essentially for work. I just can't remember what she termed it. But the third bucket was essentially in exchange for doing something for me, providing me value, I give you XRP.
Vendor did my marketing. Instead of paying you in
Correct.
cash, I'm paying you in XRP.
Correct.
Or
And
employees.
And again, like the employee stock option thing, the only reason I'm hesitant to describe it that way is because those things probably are traditionally held as fee securities. But
I
you don't
also don't think they have like a vesting schedule.
But you don't have to register those, by the way. There's an exemption there. So anyway, so with respect to the first one, she said those are securities because there's obviously an investment of money. So they went out and pitched these things to hedge funds and the like, and they said, if you guys invest in our business, we're going to use it to set up essentially this Ripple ecosystem, and when we do that, it will increase the value of the Ripple coins. And obviously, if we're increasing the value of the Ripple coins, all these hedge funds who are professional investors, right? I mean, they put money into businesses to develop businesses and make profits. That's what they do. And so she looked at all 3 of those and she said, yeah, it's 1, 2, 3. All 3 of those are met. They made representations to them as part of marketing to these hedge funds that they'd make money, and they did make money, blah, blah, blah. With respect to the second one, she said with the blind bid and ask, first of all, in most instances, a buyer would not even know that Ripple was going to get their money. Therefore, there was not, this expectation that based on the effort or what that money would be used for. So it failed that third prong. She didn't actually analyze the first 2 prongs because she said that just based on that failure of the third prong that you would be expecting somebody else to make money on your behalf. Because for all you know, your money is going to some other, XRP holder, not the company itself. So she said with respect to those, not securities.
Did that analysis surprise you?
A little bit because it's very unconventional, but at the same time, I'm not sure that.
I mean, I'll take it, right?
So I'm going to be honest. My gut read when I read the articles on it was it sounds to me like she might have got it wrong. Just having been a 15-year securities lawyer, I will say
brand flaring up.
Well, I'm curious of your opinion on this, but when I went and read it, I actually said I think there's at least a very good argument that she got it right. So I don't know if you.
I feel the same way. I think the entire industry is waiting on the edge of their seats. This thing was fully briefed in December. There were like dozens of amicus briefs filed, maybe even by some people that were in this room. And I'm waiting for this blockbuster 100-page opinion, and it comes out, and it's just like shorter, 30-page double-space opinion. Yeah. And then boom, we get this massive win out of there on what Chris is just talking about. And I mean, that you could argue that this decision split the baby a little bit. Frankly, I think those institutional sales, those were never going to be a winner for Ripple. But big win for us on the second one, on sales on exchanges. And, I think different judges could have come out different ways, which, as we'll talk about, is what happened in the Terraform case. But, great win. We'll take it.
Yep.
Can I say, what was strange for me when I read that, I also didn't really understand the decision, because if I buy Apple stock, on an exchange, right, not in the primary
Yep.
IPO, right, but I buy it later, I buy it from another person, right,
Yep.
or another entity, but it doesn't mean that Apple's not benefiting, because it doesn't mean it's not a security,
Yep.
right? So that doesn't make sense to me, that her comment was that, well, if you don't know who you're buying it from, then it's not a security.
Well, this is a super fun question, because now, you're kind of talking about your initial sales versus resales.
Yes.
Right? And in fact, there's a footnote in the opinion where the judge in the Ripple case said, I'm specifically not addressing liability for secondary sales on exchanges. That is not before me. Because as Chris mentioned earlier, this is really about when Ripple went out and sold this XRP, this fresh, new, crispy XRP, were those securities issuances. And so it's a different situation where when you have a secondary sale. If I go and buy Apple stock on the stock market, we all know that's already out there. That was a security. They did an IPO. It's been out there. It's a known quantity. XRP in this particular fact pattern was a little bit different, but would really be curious to get your take on that.
and so my gut reaction was the same, but then I thought about it more. And the Apples of the world typically get to the market in a much different manner. Like typically they go do an IPO, they get underwriters. You do all those sorts of things, that squarely brings you within the world of securities, right?
Sounds kind of like the first example, institutional investors.
Right, exactly. So I really think it was a very fact-specific thing. I think we all have that gut reaction, but it really is more like she didn't address it, but I think what happened here is more like the resales in terms of there was just no direct contact between the company and the people that actually bought that stock, nor any sort of discussion about what would those funds be used for. You could argue that these people just bought it because they thought it'd go up. Again, they're more speculators than they are investors, is maybe one way to look at it.
But that's not Ripple's fault.
Yeah, right.
That's the point. Ripple is not controlling the message. Where the judge is saying, Torres is saying, look, for institutional investors, there's no question. You pitched them. You told them, buy XRP from us, we will use it to build our business, and your investment will generate a return because your XRP will be worth more. Said the judge, can't say the same thing for sales on Coinbase. That wasn't, according to the judge, how that was marketed in connection with the sales that happened on those exchanges. Interesting distinction.
Yeah. Well, and look, the SEC loves the Howey test. We bang the drum about it all the time, and I think she did a pretty detailed and nuanced look at it. I think she even said in the opinion, I have to go look at the exact language, but the SEC's argument on that point was, well, these people would have had to know that the company was going to take that money and use it to develop. Well, that's not good enough. In my opinion, they would have had to know. The question is, what is the issuer, which is the party that issues those securities? What expectation are they setting in people's minds when they do that? And I think just here, with respect to those buyers, they didn't set any. And then the third bucket's easy, by the way. I think this one's actually much easier to understand than the second one. I apologize. I was on the phone for 2 hours before coming here, so my voice is cracking. But the sweat equity thing, people put their time and effort into it and got the tokens in return. There's just no investment of money, right? Investment of your time and effort is not the same as investment of money. And that goes right back to, what does the law say? Well, you fail on that prong, so.
That one was also a little surprising for me. I just hadn't considered that argument. And given the case law I've seen that very broadly construes this investment of money prong, that the law says it doesn't have to be, greenbacks. It can be money in its various forms. It can be stock. It can be other digital assets, anything of value. But what I didn't see coming in that Ripple case is the judges saying, well, not services necessarily, because services aren't translated, they're not assets in the same way as money and synonyms of money. And I feel like I could make the opposite argument, but again, I'll take the win. So, yeah, interesting.
Great. Let's move on to Terraform. How did that shake up the Ripple?
Which happened a week
decision?
later.
Yeah, just to give a brief context, because this is something that comes up a lot when we discuss this, is keep in mind, this is one federal district court in the country, in the Southern District of New York. The way that it works is federal courts, they divide states up into districts depending on the size of the state. Some states have 1, 2, Texas has 4, Northeast, South, and West. They're somewhat gerrymandered, like voting districts. Same thing with New York, Northeast, South, and West. And the Southern District of New York, that's Manhattan. So that's the big one, right? And so one federal court in the Southern District of New York, Judge Torres decides Ripple. It's not binding precedent on any other court in the country. So we love it, it's great, we can cite it as precedent, but is that binding on us in Texas? It's not. It's what we would call persuasive authority. Nice to have, but non-binding. So in that context, we get Terraform, a different judge, also in a federal district court in the Southern District of New York. So now we have 2 federal judges in the same district who, as I'll talk about in a moment, have different opinions about this exact issue. So in that case, Judge Rakoff was looking at Do Kwon and Terra Luna Mirror, okay? And there's a saying among lawyers, bad facts create bad law. I don't know that I would say these are bad facts in the sense, like, that saying is meant to refer to, like, really wonky facts that create bad law. These are just bad facts in that, like, it's not a good story for our friend Do Kwon. And so I think that he didn't have, and Terraform didn't have as much latitude to make some of the strong arguments that Ripple had for why the XRP for services or sales on exchanges weren't securities. They were trying to ride the coattails a little bit, and Judge Rakoff says, no. I think that all of these sales are securities. And in fact, Judge Rakoff went out of his way to specifically address the Ripple ruling and say, I don't think that, I think that the Ripple case parsed it too finely, and that the Howey test is not so fine-grained that I need in this Terraform case to make the distinction between institutional sales and sales that happen on marketplaces. And in the context of Terraform, I'm not buying this, well, bid ask, I didn't know who I was buying it from. That's not working for me, because keep in mind also this was at a different procedural stage. The Ripple case was at what's called summary judgment, which is after you've gotten all the discovery of the facts and the evidence and what have you, and then the judge is deciding, as a matter of law, should this case go to trial, or is my analysis such that there's no triable issue here, I'm going to resolve this now. Terraform is at the very inception of the case, what's called the dismissal phase, where the judge is just asking, did the SEC plead facts which, if true, would be sufficient to establish a securities law violation? So,
and not to interrupt,
No,
but
please.
and every single doubt gets resolved in their favor, too.
correct.
Yeah.
And that's a very good point. And so there,
So why are you not making money off of it?
well, we'll come back to that, and we will do Q&A later, and I'm glad you stayed, and you've got, like I said, I'm here until 9 o'clock, bud. I'll come back to that. So, so
Time clock.
at the motion to dismiss phase, you're taking all the SEC's claims as true, and what the Judge Rakoff said is, look,
Go with the judge.
the SEC has pleaded in their complaint that these marketplace retail purchasers on exchanges, they were pitched in the same way that the institutional investors were pitched in the Ripple case. And so that distinction doesn't exist. And anyone, according to the SEC's allegations, their pleadings, anyone who bought Terra, Luna, Mirror on those exchanges, they bought it with that expectation of profits from the efforts of others, and therefore it was a security. And I want to highlight another distinction, which I think for the people who are more in the tech side of crypto can appreciate. Terra Luna didn't work the same way at a structural level as XRP and the Ripple chain work, right? The whole premise is you've got the stable coin, and then you've got the liquidity pool that's backed on the other side of it, and then there's the algorithmic element that's supposed to balance it out, and then you've got the anchor protocol where, hey, it's basically a CD on steroids or a savings account on steroids where you can get 20% instead of your piddly 1% or whatever. Spoiler alert, sounds too good to be true, probably is. plus also in that period of time, 20% in crypto. Come on, this is like peanuts, right? No, but more seriously, the point is, in the context of all those representations and the way that Terra Luna worked, based on the SEC's allegations, that judge said, no, I'm not buying this distinction. No way. This is a security, and so the SEC can continue its case. Now, keep in mind, based on what I said a moment ago, the judge could reconsider his views later at the summary judgment phase. And I wouldn't write that off as impossible, but reading that opinion, it sure kind of sounds like that decision is unlikely to change pending further issues. Two other things I want to highlight briefly. One other thing that came out of the Ripple case that also got addressed in Terraform, a defense that Ripple pleaded is this fair notice defense, this kind of due process constitutional argument that we weren't able to comply because the law in this area is so confusing, and the SEC didn't give fair notice of its interpretation of the securities laws applications to crypto.
Yeah.
And in the Ripple decision, the judge said, I hear you, but if we're talking about big, heady issues of the Constitution, the Howey test is clear enough to meet a constitutional threshold. You can look at the SEC's enforcement actions. You can look at the SEC's releases on the Dow report and on its interpretation of crypto, and that's fair enough notice to satisfy that. And in Terraform, Judge Rakoff agreed. Another defense that came up in Terraform that had just ripened in the popular legal culture between Ripple and Terraform is this idea of the quote-unquote major questions doctrine. And has anyone here heard about this? This has been much talk in recent Supreme Court decisions on the student debt relief and then a few others. But basic
carbon regulation.
Yeah, that's right. Thank you. That's exactly right. So the concept is, on major questions of national importance, and what does that mean? That'll be a fun conversation for later tonight. You need clear and express congressional authorization for an executive agency to exercise its discretion. And what you've seen in the very recent past is Supreme Court of the United States decisions that are chopping away at and curtailing what they see as executive overreach into areas that are not clearly and expressly delegated under statutory empowerment. And this has become great fodder for the crypto industry. We're like, hell yeah, that's what's happening here. The SEC is doing that. And so Terraform made that argument, and Judge Rakoff said, nah, I'll pass on that one, thank you very much. I don't think, yeah, sure, the crypto industry, they think they're a big deal, but I don't think it's that big of a deal. I don't think this is a major question. And even if I did, I think that the empowerment and the jurisdiction the SEC has is enough that I'm not going to call foul on this, but that's a topic we'll come back to in the context of Coinbase. But I wanted to highlight that. Other thoughts on that?
Well, yeah, and picking it up there, I did want to mention one thing, because I've heard that. I mean, I heard it from a client yesterday, this whole major questions doctrine thing. And the reason I think it's a square peg round hole for crypto is where you've seen that be effective is like with the West Virginia versus EPA case, which was the initial case where it came out. Congress had tried for years, and people ran on a platform of regulating carbon and all these other sorts of things. They couldn't get it done because, depending on your view of things, like democracy worked, there wasn't a clear mandate. The Republicans and Democrats and what other constituencies couldn't get on the same page, so the thing died. And then the executive branch, which is largely filled with people who aren't elected. Like, I used to be in the executive branch. I wasn't elected, right? If I just decided, but if I just decided to change public policy on my own because Congress hadn't done it, that's a bit of a problem. Who do I report to? I report to my boss. Y'all can't vote me out of office. I mean, so that was the problem. And the same thing happened with the student loan thing. Same deal. Like, they've been screaming for student loan forgiveness for 10 years, right? And so the Supreme Court had a great record of Congress tried to do this for years. That essentially they could never agree on it. That doesn't mean the executive branch can just step in and do it on their own, pass their own laws. Congress passes laws, the executive branch enforces laws, okay? That's not really the scenario with crypto, right? I mean, people haven't been screaming for crypto regulation. If anything, it's been like more the opposite, like give us a lane. So I just think it's kind of an apples and oranges set of facts. I don't think there's a whole lot more to be said about Terraform other than I do think that I mean, Judge Rakoff's a very well-respected judge. So from that standpoint of somebody who would like to see that lane, it's a little concerning that his opinion is going to carry some weight, but I don't think the analysis is really that great. And I don't think there was really any need for him to mention Ripple because it's just totally apples and oranges. I mean, Terraform, the marketing across the board was essentially as a security. Like there was stuff all over the internet that anybody could see that would have led one to believe that it was an investment, unlike, Ripple. And the other thing is there's fraud. I mean, they pled in a whole lot of detail that, again, like Alex said, it was supposed to be a stable coin, and then it cratered at one point, and he entered into this scheme, again, taking the SEC at face value, to prop it back up, and then it crashed again. And so there's all kinds of factors there that just make it a different animal. And so I just thought it was a totally unnecessary thing for Judge Rakoff to even mention Ripple at all.
But we're still in the very beginning, like
Yeah.
Alex said, of the Terraform case.
But
And
yeah.
two comments about that. One, I do agree with Chris. I think Major Questions is an uphill battle.
Yeah.
If you'd asked me a year ago, I would have told you both Major Questions and Fair Notice were highly unlikely to succeed. But with the way the Supreme Court's been going,
Yeah.
and if you go and you read Coinbase's brief, which we'll talk about in a minute, never say never. It might be an uphill battle, but some of what Chris was saying about when Major Questions might apply does sound a little reminiscent of some things in crypto, maybe. The second point is, again, this precedential impact. What does it mean now that you have two courts from the same district that disagree? Not a lot.
Yep.
You can, again, I think, distinguish the facts of those cases. Ripple and Terraform are not the same in what they did and how they did it. So you can still say, okay, well, I want to go be more like the Ripple cases where I want to just go sell on exchanges, not market it as an investment, and maybe, just maybe, I can dodge a bullet if push came to shove. By the way, I don't think, and I doubt Chris thinks, that that's going to cause the SEC not to investigate you, so just put that out there. But you now have this contrary authority in Terraform, neither of which are binding precedent on the rest of the country. And what does this set us up for? Appeals. How long will that take? Years. And what that means for me is that if you're looking for the court system to give us a definitive answer on the state of crypto law, it is not coming anytime soon.
Okay. And now let's move on to the coin.
Can I add one thing?
Yes.
Because I didn't mention it, but I do actually think Fair Notice is not as DOA.
Oh, I like this.
And the reason why is because the SEC's spoken out of both sides of their mouth on it. I mean, I thought that the Ripple
Hinman
lawyers
stuff.
Yeah, right. Well, I mean, I was there when they started giving the first kind of public pronouncements on it, and there's a big debate within the commission itself, right? Because it is a 5-member body, and you've got like Purse, who's very pro crypto, and you've got others who have been very anti-crypto, and then you've got the enforcement division that's kind of spoken out of both sides of their mouths, and they've said, well, it might be, you got to go figure it out. Bitcoin isn't, Ether probably isn't, all the rest of them, figure it out yourself. Then you've got Gensler coming out later saying, well, they're all securities, which doesn't really make sense. So the point is, the SEC has done a terrible job of giving any guidance, which does raise legitimate due process concerns, in my opinion.
And you know what, since we're on it, how does time play into that, right, into the fair notice, right? So it's been going on 12, 14 years, right? Isn't that plenty of time to give somebody notice for the SEC, right? So,
Well, it's got to be understandable notice. If you say a bunch of bullshit for, pardon my French, but for 12 years,
and that's what I mean.
that doesn't
Yes.
help, right?
Yeah.
Whereas if you give clear guidance and then people have 12 years to comply, of course you're not going to have a fair notice. And this will kind of lead us into the Grayscale case. I'm sorry, actually it'll lead us into the Coinbase case where they actually sued the SEC. That might be a great jumping off point for you because that's part of the reason that the initial Coinbase case got filed where they sued the SEC.
Sure. So Coinbase, I think everyone here can appreciate, is now the legal standard bearer for the industry in the battle with the SEC. I don't think there's any two ways about it. Love them or hate them, whatever your history may be, there are people on the front line right now. Okay, and they have done so much to lay the groundwork for making our best case in the court systems. They went and worked with the SEC for years to propose drafts, send memoranda, go work with them to create rulemaking. Because again, you think about it, Chris mentioned this earlier in the context of, separation of powers and what executive agencies do. There's statutes that Congress creates, but then there's rules that the agencies create that implement those statutes. And so what Coinbase did is they went and worked with the SEC for years, 2 years, I believe, over 2 years, on proposed rules under the securities laws that would provide clarity for cryptocurrency. And these are very tangible because, as I think everyone knows, traditional markets where you have clearinghouses, settlements. Is anyone who here is familiar with T+2? Does anyone know what that is? So T+2 is the idea that when you close a securities transaction, you have 2 days to settle it. And you got to send out, notices because you have to figure out his broker has got to go to the clearinghouse, who has to tell my broker that my Apple stock is now his Apple stock, and that is allowed to happen in T+2. And it was considered revolutionary when we moved from T+3 to T+2 and maybe someday T+1. Well, guess what? Everyone in this room knows blockchain is T+0. It's instantaneous. You don't need a clearinghouse. You don't need settling parties. And so what Coinbase argued to the SEC was, look, the rules you have in place for market structure, those are for TradFi. We can do what you need us to do. We can comply, we can do reporting, but the kinds of reporting and the kinds of structures that you have in your rules, that's for the old way of doing things. We need those rules written for the way that crypto allows you to do things. That's progress. And what did the SEC do? Nothing. And so eventually, Coinbase kind of saw the writing on the wall, right? Because they're talking to the SEC, they're getting investigated, stuff's going down, they're seeing these lawsuits, and they said, you know what? We're going to get out ahead of this. And we've requested rulemaking, as is our right to do under the statutes, and the SEC hadn't done shit. And so we are going to sue and say the SEC is not fulfilling its duties to respond to rulemaking and either do something or tell us you're not going to. Make a decision. You can't just sit on it indefinitely, especially in the climate that we're dealing with where you're suing everyone left and right. And I got to be honest with you, when I saw this lawsuit first happen, I was very skeptical. I'm like, okay, good PR move, Coinbase. I don't know about this. But then something really fascinating happened. SEC, they sued Coinbase, and the complaint gets filed and hits the press. And 1 day later, the Court of Appeals, in which the Coinbase case on rulemaking is pending, on its own accord, or what we say in legal Latin, sua sponte, issued an order and said, you know what, SEC? Now that you've sued Coinbase, we do want you to come and tell us they gave them a short deadline. They gave them like a week or 10 days. Tell us in 10 days why we shouldn't, understandably, take Coinbase's side of this, because you're refusing to make rules that would help clarify things for crypto, and now you just turn around and sue them. So it kind of sounds like you've already made up your mind that you're not going to. The SEC came back 10 days later, and what'd they say? No, we're still working on it. Give us until October, and we will either make a decision or we will advise you of the status of our work on this. And that was enough to cause that court to chill, and we will see what happens. So the fact that that happened, the fact that that court and those judges cared enough to order the SEC to do this, signals to me that they're taking this very seriously, and that's a ray of hope for me in this whole process. Then the SEC suit against Coinbase, very obvious textbook. You're selling unregistered securities on an exchange. You're not registered as a securities exchange. There's 12 tokens listed in the complaint that they allege are securities as examples, okay? And just last week, Coinbase filed a motion to dismiss that complaint. Again, a motion to dismiss is just on the pleadings, no evidence, just on the pleadings. And Coinbase is represented by two powerhouse law firms, Wachtell and Sullivan and Cromwell, two of the most prestigious firms in the country that do this kind of litigation work. And I highly encourage you to read their motion to dismiss. It's written very well. It's very persuasive. It does a lot of the same kind of Howey analysis we're talking about, and it argues these other decisions, the Ripple decision and the Terraform decision. It reconciles everything in the context of Coinbase, and it also takes up the arm of the major questions doctrine and continues to advance it, citing all of the efforts that have been happening in Congress to do crypto market structuring bills and things of that nature. And look, I'm not saying I think that it's a slam dunk. far from it. As Chris can confirm, motions to dismiss are often denied because it's just the pleading phase. Like, let's get into the meat of it before we make any big decisions. But to me, all of this in context signals to me that Coinbase is taking this as seriously as any company could possibly take this, and is fighting this war on every possible front to try and advance the cause of the industry.
Yeah, and one other unique curve on the Coinbase District Court case, because as Alex mentioned, there's the one that's at the Circuit Court level, the Court of Appeals level, and there's the one at the District Court level, which is where the SEC is the plaintiff. A unique spin on that one is they have had one hearing, and one of the things the judge asked about at the hearing is because Coinbase is publicly traded. I mean, they went to the SEC, they filed a registration statement, they approved them to be listed as a publicly traded stock in the US, and there was an interchange that was reported between the judge and the SEC, and subsequently Coinbase's counsel, who's a guy named Steve Pekin, who used to run the enforcement division when I was there, and she said, well, SEC, it does seem weird that if you essentially think their business is illegal, you would let them become a publicly traded stock. Shouldn't that concern me? And they said, well, we didn't say what they're doing is legal. I mean, that's just kind of more of an administrative thing. Like, they kind of try to punt it that way. Which, think about that, right? Like, you're the SEC, you're going to let a bunch of people from the public market, pension funds, whatever, you name it, right? Grandma and grandpa go buy Coinbase stock, yet you think their business is illegal?
Let's riff on this. Oh, sorry, go.
Yeah.
Let's riff on this a little bit, because
Yeah.
this is a super fun topic. This first came to my attention in a completely different context, the Bigfoot IPO. There's a company that was out hunting for Bigfoot. And the analysis on this issue was, look, just because the SEC approved your IPO doesn't mean the SEC is in any way commenting on whether Bigfoot exists or whether it's a legitimate thing for you to invest in Bigfoot hunting or whatever. And I'm like, okay, I can wrap my head around that. And so then I heard this argument about Coinbase, and this came up in congressional hearings on the House crypto market structuring bill. And there, one of the panelists actually, who was here, the Steptoe lawyer, whose name escapes me, but he had a really clever point about this. He's like, look, it is, for the most part, considered administrative. It's not considered that big of a deal. You're not blessing the validity of this. But if you take this a little further, what about the cartel? Like, if you had a crime cartel or a child sex trafficking ring that wanted to go public, are you saying that if they filled out the forms correctly, you'd be like, fine, you can go public? Hell no.
Bingo.
If what you were doing is facially in violation of the law, that's not does Bigfoot exist or not. That's you are running a criminal enterprise. Oh, but it's just administrative, so I'm just going to check the box. Give me a break. There has to be some point at which there is some kind of public policy and interest analysis that goes into what you allow to go public, and it ought to matter. And I thought that was very clever.
Yeah.
Chris?
That's exactly what I was going to say. I mean, and Pekin, when she asked him about that, he said, I think you're exactly right to be concerned about it. So, whereas like in Terraform, bad facts may have kind of made bad law for us on that one, I actually think this is where bad facts may make bad law for the SEC, where they're just out there over their skis and the judge is going to say, this just doesn't make sense, right? So we'll see what happens, but.
Okay, and what about Grayscale? How's that different?
I know we've been going a while. This is one I think we ought to go over pretty quickly,
Yes.
but Grayscale is a case where Grayscale's tried to set up essentially a ETF that's tied to crypto, and a bunch of companies have tried to do this recently, which is why I'm not going to necessarily limit it to Grayscale. It was a Bitcoin-based ETF. The SEC rejected the application, and they come up with all kinds of reasons, but at the end of the day, they said they weren't comfortable with the way market prices would be reported so that they could know that there was not fraud going on. So Grayscale ultimately filed suit against them and said it was arbitrary and capricious for them to reject the application. Now, I will say since that time, there's been a lot of action, and a bunch of other ETF applications have come down for both Bitcoin and Ether-based ETFs. It does seem like there's maybe a little bit more appetite there for the SEC to do it. So I wouldn't be surprised if this is one of those cases where it gets resolved or dies on the vine or something, depending on what happens with these other applications. But if it doesn't, I mean, again, the SEC is going to have to explain. And they've got a renewed application, by the way, that's out there with this market surveillance agreement where we could get real in the kind of nerdy securities weeds on that. There's no need to.
This is a really interesting topic. Ask us about this later, this
Yeah.
market surveillance issue.
Yeah. But anyway, I wouldn't be surprised if this one kind of resolves itself. But if it doesn't, this is just going to be a further case where the SEC is going to have to explain, like, what's the rhyme or reason to what you're doing here. I don't know if there's much you want to add to that. But.
That's good.
Well, so then let's move on to talking about how you think things are going to play out. So Alex, you mentioned before that you think that the case law is going to take years to be formed because all these arguments and these cases are going to take so long. So where do we think, how is crypto going to come to be regulated if it's not because of these SEC actions in the court of law?
Here's my crystal ball. There are three branches of government. There's the executive, the courts, judicial, and then there's the legislature, okay? Three tracks where you can potentially get legal clarity. We've already talked about the courts. I think it probably will get clarity once it gets appealed. Who knows, maybe even to the Supreme Court. It's going to take forever, years. And by that I mean like not like 2 years, maybe 3, 4, 5, depending on how long the process goes, longer, okay? 10 years. In the executive branch, if you elect a new administration, a new president, maybe Gensler's out. Maybe you elect the same president and there's a turnover anyway and a different chair has different views. It's possible, very speculative. I'm not betting on that election, but ask me about when I bet on the 2016 one because that's fun. The third is the legislature. And again, had you asked me a year ago, I would have told you, legislature? The legislature can't get anything done. On crypto, they're making progress. I could talk, and if anyone wants to ask me afterward, I've been talking a lot with members of the House Financial Services Committee and Agriculture Committee, because it's weird. Agriculture oversees the CFTC because commodities starts out with ag commodities. So there's a joint committee of the House Financial Services and Agriculture Committees that have been working on crypto market structuring to divide up jurisdiction between the Commodities Futures Trading Commission and the SEC. And their bill is good. It's really interesting because it answers questions. When are you decentralized enough that you wouldn't need to register as a security, that you would be exempt from being considered a security? And it has a definition from that.
Q&A is coming soon, please wait.
And how do you get into a safe harbor and color with inside the lines so that you know you're not going to get tagged by the SEC? And I was skeptical about whether this would pass, but the committees passed it. They were able to reconcile it. It hasn't been on the House floor yet, but I'm optimistic it can pass. Meanwhile, in the Senate, you've got the Lummis-Gillibrand bill that's been revived. It's different in its approach. It uses some different pathways, but same basic concept. They both have this kind of 1-year safe harbor for crypto companies that if they meet certain thresholds to operate free from concern of SEC. Again, none of this waives fraud. If you're committing fraud, you're still hosed. But they provide clear legislative paths to compliance. My educated guess is even if the House and the Senate floors pass these bills this year, they're different substantially, and they're not going to get reconciled in this legislative session. But there's enough momentum and interest that I think it is conceivable we could get it done next year, and that would be phenomenal. And so I currently believe that is the quickest path to regulatory clarity. So lobby your members of Congress, take them to dinner and do whatever, and I can help you do that.
How will that affect the current cases that are already happening?
That's a fantastic question. Laws often are not retroactive in their application. And this touches on another weird issue in crypto, which is it may be a security one day and it may be a commodity the next. And so we'll have to wait and see what the final legislation provides in terms of retroactive application. It's conceivable that it would protect, on a going forward basis, crypto operations that comply with it, but would not forgive past sins. Like if you went and you did a shitcoin offering and raised millions of dollars on naked sales to the public, I'm sorry, but this legislation is not going to save you. But it may protect you going forward. And one thing I'm interested in and have been working with clients on is, can we make educated guesses about what this final legislation is likely to look like? And can we go ahead and start taking steps to comply and anticipate with what we expect the regime will likely be so that when it does pass, we'll be ready to take full advantage of that and be in full compliance.
Yeah, I agree. Amy's been hearing me do panels for like over a year, and I've totally pulled a 180. I've been saying for a year that Congress is worthless, and this is just going to have to play out in the courts, and it's going to take a while. But like Alex said, I mean, you've now got a bipartisan bill in the House. It's made it through committee. You've got a bipartisan bill in the Senate. How many bipartisan bills do you have at all in today's world? Crypto is interesting, right? I mean, it kind of brings people that have widely divergent views in other areas of the world kind of together for different reasons often, which I think is why these things have kind of worked through on a bipartisan basis. But I'm pretty optimistic. The thing I like about the House bill in particular, it's not like I've sat there and studied these, but it like to me the most important thing that it just provides is definition.
Yes.
Like it defines crypto securities and it puts the SEC in charge of those. It defines crypto commodities, it puts the CFTC in charge of those, and then it provides cryptocurrencies and it puts Treasury in charge of those. So now instead of trying to figure out where do I fit in, and like right now you could conceivably have all three of those looking over your shoulder.
It settles the turf war.
No, like that's number one. It's so fundamental, right? But tell me what I am.
Yeah.
It doesn't actually radically change the regulatory regime beyond that. It just tells me whose rules am I playing by.
All right. Well, then let's open this up to Q&A. Questions? Go ahead.
Alex, you touched on the matter with Terraform where they kind of had this thing going on where they both had a stable coin and the unstable coin. They had Terra and Luna.
Unstable coin, yes,
Yeah,
exactly.
very unstable portion. From a securities perspective, maybe you mentioned
Who got
this,
rugged on Terra? Sorry.
I might have just not understood the nuance, but did the SEC view those two different tokens differently? Did they view one as more of a security than the
No.
other, or was it just the whole project was considered?
So the SEC alleged that both Terra and Luna were securities. There's no ambiguity about that. Now, do those tokens do different things? Yes. Again, one is intended to be a stable coin. The other is intended to essentially collateralize that and maintain its peg. Didn't ultimately work. Interesting idea. Maybe it could work. Didn't work in that case. What's really interesting to me to riff on that is who here works in DeFi? Yeah, a few people. So you've got liquidity pools where I may not even be doing anything on Coinbase. I may be going to a decentralized exchange and I may be launching a token with a liquidity pool where I'm creating my own balance. And I think that from the SEC's perspective, your analysis, your basic Howey analysis is still going to apply. But I'm really interested in this idea that kind of Hinman kicked off and now the House bill codifies that. Are you ever sufficiently decentralized such that you couldn't say any one retail purchaser is relying on the managerial efforts of a specific group of people? Because our project is so decentralized that there is no managerial control. No one is at the helm. Certainly that's true of Bitcoin, or at least I would argue it's true of Bitcoin. Arguably true of Ether. I think it is true of Ether. And so for the DeFi projects, I think this is really interesting. And although Terra Luna, I would not say was decentralized in that way. The way that it had this pairing, Terra and Luna, it reminds me of the way that you see pairings in liquidity pools, where this is an issue, for example, for Uniswap, for Curve, and for other pooled assets.
I'm sorry, just to go a little further on that one. Does the SEC ever differentiate between stable coins and other types of, have they ever?
Well, taking it back to that was an easy case actually because they called it a stable coin, but it wasn't really a stable coin. So it kind of made it easy. The SEC's coming in after the fact saying that it wasn't. I mean, I do think they could, and then actually back to legislation, there was a stable coin bill kicking around too. I haven't
They
checked
both
into
passed.
Yeah.
And the Lummis Gillibrand bill combines them.
Yeah, and so again, if you look forward, I mean, in theory, a stable coin is nothing but a medium of exchange that would allow you to not use dollars, right? That's not a security, right? So, which is again what it was pitched as in Terra, but not at all what it turned out to be. And so the SEC is always going to say, what is it really? Like you can call it a stable coin, And if it's not really a stable coin, then it doesn't matter what you call it. So it all comes down to you know, substance over form. Yeah.
I mix it up too
It's not
sometimes.
form over substance. But the point is, I think, yeah, and would the SEC treat it that way if it's truly a stable coin? I don't think you'd see them go sue people over a legitimate stable coin. I mean, I can't recall a case, can you? Of a truly functioning stable coin where they've,
Show me the truly functioning stable
well,
coin.
that's a
but
good point
yeah.
in and of itself. But,
Yeah.
That makes sense.
but it may get resolved through this legislation, and that's got all kinds of requirements in terms of what's a real stable coin, even including like reserves and things of that nature, reserve requirements.
And so ask us afterward about legislative requirements for that. It's fascinating. I think you had your hand up.
Yeah, so I have a question regarding NFTs. So what bells and whistles, if you will, if you were to add to the NFTs to help ensure that you will never be considered a security?
Good luck, because if Dapper Labs can get sued over digital trading cards, what can't be? That one blew my mind. That case is still pending and I'm watching it. But let me riff on that for a second. Bored Ape Yacht Club, okay? I think a lot of the NFT projects, in my mind, because I will admit, I missed the NFT wave. You know, I was in Bitcoin, I was in Ethereum, and then when the initial NFT wave hit, I was like, this is not for me, it's digital JPEGs, whatever. But I didn't understand what they were doing. Now, what I understand in hindsight is tokens like Bored Ape Yacht Club, it's kind of like a digital country club membership, right? You're not buying, well, obviously you're not buying it for the JPEG unless you think they're really cool or whatever. You're buying it because it is rare, it conveys a certain social status within crypto space, but also it gives you access to this digital country club, which for Bored Ape Yacht Club is what, it's like the bathroom or whatever, they have the graffiti wall. And there, you're gonna have some of the same issues because, as a side note, I don't know if anyone knows this, country club memberships are securities. They're private securities, they're private offerings, but your membership of a country club is an equity ownership share of that club. And so I do think that there's exposure for certain NFT projects where I'm selling an NFT and then using the proceeds from that to build the digital country club. That's an investment where you're expecting value from the efforts of the people building it. So the answer to your question is, I think the way you mitigate that risk is by making it more like a digital trading card, more like an asset and less like an investment. You're not taking money to build something new, you're taking money for people to interact with something that has already been built using self-funding, using private offering funds, private fundraise, foundation funds, things like that. And that does exist, and there are a lot of NFT projects that meet that definition. In my opinion, Top Shots ought to. I mean, good God, you're gonna tell me the NBA, you know, they need to raise Top Shots money to build their platform? Give me a break, you know? So I do think there are ways to do that, but let me just be very clear. There is no safe space in crypto, at least right now.
It's interesting to me, I didn't know that, like social clubs like country clubs are securities. Are they actually doing what?
If there's an investment component, there's actually a really old no action letter on that.
Oh,
believe
no
it or
kidding.
not. I had to deal with this a few years back because I had a friend who was doing like a hunting and fishing club in East Texas of all things, and they just used some agreement they'd used from some other prior one, and they gave a residual profit to the members of the club. Bingo, you got a security. Now there is an old one that if it's just purely for member benefits or something, there's a way to structure it where you can get around it. But like Alex says, if you're like an equity membership, that type of thing, where there could be some sort of residual profit to the members, you got a security. So.
Then again, it kind of sounds to me like the SEC right now isn't making the same distinctions when it comes to crypto that they already do in the
Well,
rest of the world.
but again, like
right?
country clubs, when they're selling country club memberships, they're doing private offerings. You
Yeah.
know, they're exempt from registration because they're not selling, you know, Austin Country Club memberships on the open market to anyone who will
But
buy
then you have to
one.
be accredited, right? And then they have to make sure that you're accredited.
Accredited or a certain number of unaccredited, there's all sorts of different ways you can do it, but you're correct.
But what I mean is, there's a distinction between, is it a membership for equity with profit, or is it just a social membership?
Correct.
And so, meanwhile, in crypto, I don't know if Gensler's really making that same distinction.
Well, and this is another great point. I'm really glad you brought this up because, and this is a huge tangent, I'll be very brief, but I think there's space for nonprofit associations that issue digital tokens that are basically membership tokens. And if it's a nonprofit, civic organization like the Austin Dow, anyone Austin Dow people here, I think you've got a pretty good case that's not a security, because it's not a for-profit activity where you're expecting a return on investment. It's a social club or a civic organization, a nonprofit association, and I love that use case. I think it's really interesting.
Does the voting mechanism factor in there, that it's not for a corporation like Yuga Labs or something like that, or?
You want to talk about that one?
Well, it can. I mean, and that's where you can actually make the distinction right back to like your traditional investment products, like oil and gas. Crypto's weird. I end up anyway comparing a lot of it to oil and gas, but depending on how it's structured, like oil and gas companies often sell limited partnership interests, but then you got to go look at the agreement and what does that limited partnership interest entitle you to do? If you can actually, like if all these individual owners are essentially running the company, well, that's not based upon the efforts of others. That's an active investment, not a passive investment. It's not a security, okay? If those same LP investors, like what a lot of those agreements say is the LP investors have very limited control over the corporation, like just lipstick and blush and whatnot, but with the nitty gritty, they can't really control any of that. Those things are always securities. So it all depends. I mean, that's a very unsatisfying answer, but in that respect, it's similar to so many other investments. Like the security saying, it always usually comes back to investment contract analysis and what is the purpose of your investment? How much say do you have in the operation of the entity that's going to take your money and do whatever it does with your money? If it's a passive investment, it's probably a security. If it's a non-passive investment, then you're essentially kind of just a little small business owner who doesn't need all the protections that a passive investor has, because then you got to step back and say, why does the law work the way it does? Well, it's designed to protect passive investors, right? So that bad actors can't get your money and do bad things with your money. But if I've got say in that entity and I can control its operations and I can vote out the bad actors or take those other sorts of actions that they're doing bad things, I don't need those protections. It's kind of the same way that the banking laws work.
All right, I got to run with this just for a brief moment because you brought this up. So now I've got a great idea. I'm going to go sell a bunch of tokens, and I'm going to give governance rights to all my token holders, so I don't manage anything. It's all the token holders. They're the ones who have the sole control. So I'm not a security, right? Maybe not. But you also may now have created a general partnership. And now every one of your token holders is jointly and severally liable for whatever your token organization does. And this is exactly what happened in the Uki Dow case in California. Ask me about this later. Absolutely crazy.
Right. So you may get out of the securities thing and create all other sorts of problems for yourself is the long and the short of it.
Anyone else have any questions?
Wasn't Terraform Labs not even an American company? Weren't they a South Korean company?
Oh, you want to cover jurisdiction?
Yeah,
that was my
but
question. How did the American court
if you
decide?
either direct your investments into the U.S. or you've got, I'm not trying to use the clunky because there's a real term for general solicitation, or if you're just doing some sort of general offering and you're not actively screening out U.S. investors. I mean, the fact of the matter is, there's a lot of people, like I sued a company that was out of Austria when I was with the SEC that was doing that exact same thing. They said on their website, not available to U.S. investors. And then they took a bunch of money from U.S. investors. And they weren't doing any sort of KYC. They weren't doing any sort of IP blocking. Not that you can't use the VPN to get around it, but they weren't even trying, right? Like they knew a bunch of the money was coming from the U.S. It was the same thing there. I mean, if you're directing any of your marketing to the U.S., you've submitted yourself to U.S. jurisdiction no matter where you are. Now, it may be hard for them to come get you. That's a totally different question.
Does your country have an extradition treaty with the United States?
Yeah, right.
Okay, well, let's wrap this up. So thank you, everyone. Sorry we ran a little long, but I don't know, I thought it was so interesting that I tried not to cut them off. But I like legal cases, so, and I watch a lot of Law and Order. So thank you so much. I really appreciate that you guys spent time, and you're not even living in Austin, so thank you so much for coming down and really
Happy to be
giving us
here.
your time and experience.